In this week's video, we'll be covering an extremely rare signal on the NASDAQ that has only occurred 15 times in the last 42 years. We'll cover the NASDAQ in the first half of the video and the S&P 500 in the second half. This is weekly MACD on the bottom of the screen that helps us measure momentum. The first part of our rare setup. The week of November 16, 2018, the NASDAQ crossed below the center line or zero line. From stockcharts.com, MACD will remain positive as long as there is a sustained uptrend. MACD will remain negative when there is a sustained downtrend. You can somewhat think of it this way. This bearish MACD cross occurs above the center line and can be thought of as a counter trend move within the context of an existing uptrend. Those probabilities start to wane, and it starts to look more like a new downtrend when black MACD crosses below the center line or zero line as it did in November of last year. And since on a longer-term basis, for the most part, the NASDAQ and the S&P 500 zig and zag together, this analysis is also relevant for the general stock market. If we fast forward to March 8th, 2019, which is a Friday, this is the second half of our signal. MACD black crossed back above the zero line or center line. You can see here on your screen, it ended the week, got a weekly close in positive territory. Thus, our relatively rare NASDAQ signal is defined as follows. MACD crosses below the center line on a weekly closing basis and stays below the center line for 3.5 to 4 months at least. So let's say roughly 4 months. And then closes back above the center line. If we fast forward to the same chart as of the close on Thursday, March 21st, 2019, you can see black MACD is all the way up to 69, telling us that it's extremely likely that we will get the third consecutive weekly close above the center line or zero line, and that is also something that we looked for when we are making historical comparisons. This portion of the video is being recorded after the close on Friday evening, March 22nd. I'm off-site and recording with my PC, so if the audio is a little off, let's just pretend we're doing a Skype interview. NASDAQ weekly did hold the third consecutive weekly close above the center line, with black MACD closing at 53.6. Thus, when we're down here, we get a bullish MACD cross, but we're below the center line. So from a probability perspective, this still, for the most part, looks like a counter trend move within the context of an existing downtrend. Those probabilities start to wane, and it starts to look more like a new uptrend when MACD recaptures the center line. Thus, if the present day is starting to look more and more like a sustainable uptrend, a fair question is, did anything like this happen? 3 consecutive weekly closes above the center line after falling below the center line for at least 3.5 to 4 months. If the answer is yes, this really doesn't do much in terms of helping us differentiate between 2019 and a counter trend move within the context of a bear market. If the answer is no, it tells us that 2019 is starting to distance itself from the theory that this is a counter trend move within the context of an existing bear market. So let's check out the dot-com bust bear market. Still looking at a weekly chart of the NASDAQ, MACD gets the center line bearish cross on Friday, September 29th, 2000, and then stays below the center line for roughly 4 months. This chart here is as of January 26, 2001. If we fast forward to the end of the bear market, the answer to our question, did something similar happen during the 2000 to 2002 bear market? Meaning, were we ever able to get 3 consecutive weekly closes back above the center line during the dot-com bear market? The answer is a definitive no. If we zoom in on this area here, MACD never even can get 1 week in terms of a closing basis above the center line. We come close here, and this counter trend move rolls over. This did end up being a counter trend move within the context of a downtrend. Right here, this bullish cross below the center line does end up being a counter trend move within the context of an existing downtrend, and we go on to make a lower low. Next question, how about the 2007 to 2009 bear market? It appears that on Friday, March 22nd, we will nail down, and it will go into the history books, the 3rd consecutive weekly close above the center line. Here's our step 1 in 2008. We get a weekly close on January 11th, 2008 below the center line. And if we fast forward to the end of the bear market, or March 9th, 2009 on the weekly chart, you can see the answer to our question is no. Once we cross below, we never get even a single weekly close above the center line. Here's our bullish cross, but it happens below the center line. Odds say this is a counter trend move within the context of an existing downtrend, which is exactly what it was. Odds say this move is a counter trend move within the context of an existing downtrend, which was followed by lower lows in the NASDAQ. Thus, from a probability perspective, much like the Bollinger Band charts that we covered for the S&P 500 last week, which showed that 2019 looked discernibly different than anything that happened in the 2000 to 2002 bear market, the 2007 to 2009 bear market, and in that case, because the S&P 500 was around, the NASDAQ was not. Last week, we showed the S&P 500 looked discernibly different than during any point during the 1974 to 1975 devastating bear market. Does this mean that we're out of the woods and everything is fine? Absolutely, positively no. It simply speaks to the probability of good things happening relative to the probability of bad things happening. Now that we're above the zero line, and we're above the zero line for 3 consecutive weeks, it's saying that this move now is looking like a sustainable trend rather than a counter trend move within the context of an existing downtrend. All to be determined. If this didn't happen in the 2 devastating bear markets, how many times has something similar happened since the NASDAQ came into existence in the late 1970s? And what happened next in the NASDAQ after this setup here? From a frequency perspective, dating back to 1978, we have seen 14 similar setups on the NASDAQ Composite weekly. Let's cover 4 of them from a visual perspective. So in each case here, Black MACD is below the center line on the NASDAQ's weekly chart. It stays below it for roughly 4 months or longer, and then it recaptures it on the date shown on each of the 4 charts. In this case, September 24th, 1982, MACD closes above zero. MACD closes above zero here in 1991. Here it closes above zero in 1994 and gets its first weekly close above zero on January 13th, 2012. So this point A here, and this point A here, here, and here, they're very, very similar to this point here in the present day, which occurred in early March of this year. You can see in each case here some ugly things were happening in the rearview mirror. If we fast forward to point B, 3 years down the road in each case, how did the NASDAQ perform? 3 years down the road, 51% gain. 3 years down the road, a 78% gain. In this case, over 100%, and in this case, 72%. But what's more relevant is what happened in each case. There was 14 of them. It's easier to summarize that with a table. So let's walk through the first case. On September 24th, 1982, we got the first weekly close, NASDAQ MACD above the center line. 1 month later, the market was up 8.4%. 6 months later, it was up 42%. 3 years later, 51%. You can see in each case, the average and median gain, looking out 1 month to 3 years, all of them constructive. And maybe more importantly are these numbers here. 2 months out, 85% of the cases were positive. Same thing can be said for 3 months out, 6 months out, 1 year out. 92% of the 14 cases produced positive returns with one exception. And 3 years from this date here, the average gain was 50%, the median gain was 51%, and 92% of the cases produced positive returns. And even in this case, before this number here and this number here, the NASDAQ gained over 20% 12 months down the road. Every year is different, and 2019 will follow its own path. This helps us understand probabilities based on actual market history. After Friday's week session, it opens up the possibility of revisiting the inverse head and shoulders scenario that we originally covered back on January 25th. Since we've been using weekly charts, we'll stay with weekly charts. Left side of your screen, S&P 500 weekly, close Friday, March 22nd. Right side, NASDAQ weekly. The traditional way to draw a neckline is to draw a horizontal line, or at least that's the textbook pattern. If we do that for the S&P 500 weekly, you can see even after Friday's week session, we still closed well above these closing levels from late 2018. So this still falls into the to be determined category relative to this breakout here. Similar situation with the NASDAQ weekly, but really even better. You can make an argument that this is a bullish breakout here. This is a successful retest, and then we made a higher high, and Friday's week session doesn't really change any of that. And then we have to look at all of that in the context of getting the bullish MACD cross here, a bullish cross here, and then the cross in both cases above the center line, and in both cases holding above the center line as of the close on Friday, March 22nd. Another possible way to look at things is to draw an upward sloping neckline in both cases. Then we can make an argument that this is our left shoulder and we're forming a right shoulder. Left shoulder forming a right shoulder. If you know inverse head and shoulders patterns, you know that if this indeed turns out to be an inverse head and shoulders pattern, and we have an upward sloping neckline, that tends to be bullish, and common sense tells us that that's bullish. Bullish conviction was able to drive prices higher, resulting in an upward sloping neckline. If we had a downward sloping neckline, it would lean bearish from a probability perspective. Observation number 2, if, and I can't emphasize enough, if We don't know if this is going to be an inverse head and shoulders pattern. It is one of many possible outcomes. If that's what's happening. Right now, it looks like the right shoulder is much more shallow than the left shoulder formation. Once again, that leans bullish and passes the common sense test. In this case, bearish conviction was able to push prices down to this level here. Thus far, bearish conviction has only resulted in us moving down to a much more tame or shallow level. The same thing can be said for the NASDAQ. How this plays out totally falls into the to be determined category. We're simply talking about what we have in front of us as of the close on Friday, March 22nd. And if you know inverse head and shoulders patterns, you know that you can make a back of the envelope projection if this turns out to be that type of pattern. You take the distance from the bottom of the head up to the neckline, and then you extend it from the breakout on the neckline. Similar situation here. Not forecasting anything. This is one of many possible outcomes. Another possible outcome is to form a more traditional right shoulder that would see both markets come down to this level here and this level here to try to get some symmetry to the pattern. Now we're switching gears to the S&P 500. You should be able to Google this title here and our last name Shavako to find this post on our blog Short Takes dated March 19, 2019. In this case, we're looking at the daily chart of the S&P 500. Monday, March 18th, was the first daily close above the upper Bollinger Band since the low was made in December of 2018. If you know Bollinger Bands, sometimes when you get near the upper band, you can get some type of give back or some volatility that follows. Therefore, we wanted to know, dating back to 1950, how many times has something similar happened and what happened next? So going back to 1950, we're looking for the first daily S&P 500 close above the upper Bollinger Band after a 14 to 30% drop on the left side of the chart. Back to our question. How many cases could we find since 1950? The answer is 15 cases. We'll cover them all, but let's look at 3 of them visually. So in every case here, we have a 14 to 30% drop on the left side of the screen, a big drop over here, and a big drop over here. We get a low, a low, a low, and then the first daily close above the upper Bollinger Band here, here, and here. All 3 of these point A's are very, very similar to the look on Monday of this week, or this point A here on March 18th, 2019. In these handful of cases, if we fast forward 3 years down the road from point A, you can see in every case really good things happen for a long period of time. But once again, more importantly, relative to assessing the setup in the present day, we really need to look at the favorable cases and the unfavorable cases, which is another way of saying all of the cases dating back to 1950. So once again, we're looking at S&P 500 returns from the date of the first daily close above the upper Bollinger Band following a 14 to 30% drop in the S&P 500. You can see amazingly, in all 15 cases, the market was positive 3 months down the road, 6 months down the road, 1 year down the road, and unbelievably, every single case was positive 2 years down the road, the average gain of 30% and a median gain of 30%. And in the historical cases, present day may vary significantly going forward. In the historical cases, the worst return was a loss of 6% looking out 2 months from the signal in calendar year 1962, but eventually 1962 produced very satisfying returns. Once again, if you know Bollinger Bands, you know when we get to the upper band, sometimes you can have a give back. So maybe more importantly, we wanted to know, what do the drawdowns look like short term after this setup? You can see in a handful of cases, 84, 82, 80, 1950, and 1953, the market never looked back, never had a drawdown or went below the S&P 500 level at this date. And in every case, we're anchoring this date. So we're looking at the maximum drawdown going forward from this point and the maximum drawdown going forward from this point. Meaning, if you never drop below this point, you'll have zeros in the table all the way across. So once again, in the historical cases, the average drawdown 2 weeks out, 0.8%, 1 month, 1.3%, 2 months, 1.9%, and 3 months, 2.32%. Meaning, on average, looking out 3 months from this point here, the market fell roughly 2.32% below this level, and on a median basis, it was roughly 1%. So once again, we have a setup, and that's all it is a setup that historically has produced extremely favorable returns with very muted drawdowns. After Friday's week session, it might be helpful to see visually in 2019 what would the maximum, average, and median drawdown look like on a present day chart based on the historical drawdowns. Our starting point is the day that we got the first close above the upper daily Bollinger Band, which was March 18th, 2019, and the S&P 500 closed at 2832.94. Thus, if we take the average, median, and maximum drawdown from these historical cases and put them on a graph, this is what they would look like. The average drawdown with the Bollinger Band set up. Let's see the S&P 500 backtrack to these lines here. Thus far, we seem to be within average and normal bounds. Similar situation with the median drawdown. Thus far, looks pretty typical from a median perspective. And in a handful of cases, this is the maximum drawdown. So this line is based on 1 of 15 cases. And we're looking out 2 weeks, 1 month, 2 months, and 3 months. So we've got 4 lines on the chart. We're looking at the maximum drawdown out of all 15 cases 2 weeks out, and then 1 month out, 2 months out, and 3 months out, telling us it is within the realm of historical possibility that the market could come back to this level, this level, this level, this level, this level, or this level, or any one of these levels here. And from a historical perspective, that would keep us within the boundaries of remaining on track potentially for very favorable outcomes after the drawdown, looking out 3 months, 6 months, 1 year, 2 years, or 3 years. All of this tells us from a historical perspective, in many of these cases, if an investor wanted to capture these very satisfying returns in the table, they had to be willing to withstand and remain patient through a drawdown and a period where their balance moved from point A to point B, and the market moved from point A to point B. Understanding this in advance can help us keep an even keel emotionally and review the data in an unbiased and objective manner in the days, weeks, and months ahead. Let's update the bull-bear roadmaps that we've been looking at and covering in these videos since January. Our moving average cluster examples, we said we would learn something either way back in February. If we fast forward to March 21st, 2019, it's pretty fair to say the things that we've been looking for in the bearish setups are not happening in the present day. And as you can see, the week session in the S&P 500 on Friday, March 22nd, did not materially change the look of this chart, and thus we do not have to edit or alter any of our comments that were based on Thursday's close, March 21st. Here the market has trouble clearing the 200-day. Here it has trouble making higher highs after clearing the 200-day. Here we don't get anywhere near the 200-day in orange. Here we're rejected at the 200-day in orange. And in this case here, we get above it, but then we make a series of lower lows. In the present day, probably fair to say that this, so far, looks a lot more like our bullish roadmap. We've been talking about wanting to see the market clear the 200-day and hopefully consolidate above it. Clear it, consolidate above it, clear it, consolidate above it, clear it, consolidate above it. We have no idea what the next few weeks are going to look like, but it's fair to say so far, March 2019 looks a lot more like our bullish examples that we've been looking at since January relative to our bearish roadmaps. Remember, several weeks ago, we said often the market comes up off of a low, and even with relatively weak trend strength scores, you can feel like you're missing out. But typically, when the market's ready to move, the scores get much more constructive. When the market's ready to move, the scores get much more constructive. Here, low score, bad things happen. When it's ready to move here in 2016, the scores get much more constructive. If you're a client, you can tell by how much cash we have that the scores in the present day are much more constructive. Historically, based on the setups that we just covered for the NASDAQ and the Bollinger Band setup for the S&P 500, while it's easy to feel like we're missing out down here, this point A is similar to March 8th of this year. This point A is similar to March 8th of this year. The same can be said for this point A and this point A. Typically, the market gives you time to migrate back to a fully invested stance, and good things can still happen for a long period of time. If anybody makes anything remotely close to these returns, looking out 3 years, it's doubtful that they're going to feel like they missed out. It'd be easy to feel like you were missing out right here and missing out right here. We should keep in mind, in terms of our Bollinger Band setup, this date here on the left side of the table is similar to Monday of this week. If the next 2 to 3 years looks anything like the returns in this table, it's very, very doubtful that anyone will feel like they're missing out. All of that is to be determined, and 2019 will follow its own path. One of the reasons why we like to look at the visuals, if you simply look at a table or someone tells you that the average return looking out 2 years was 32% and the median return was 34%, we can get very unrealistic expectations about market volatility going forward. Likewise, if we simply look at the returns in this table here, as humans, if we were to watch this video over the weekend and the following week in the stock market is red, our tendency would be to say this is wrong. As we have noted many times in the past, even if really good things happen for a long period of time, we can expect gut-wrenching volatility between a point A and a point B that could be several years down the road. That applies to all four cases on the screen. And even if really good things happen between a point A and a point B that could be several years down the road, to capture even a portion of these satisfying returns, you had to withstand a lot of volatility, you had to have a lot of givebacks, and a lot of fluctuations in your account balance, which is very, very easy to understand when the market's closed. It's a lot harder when you're looking at red screens and minus signs to remember the historical volatility. How does all of this help us? As we discussed last week, the technicals are helpful because it's the net aggregate opinion of all market participants that moves markets. It really has nothing to do with personal opinions about the present or the future. The technicals and the data, including the historical setups that we've just looked at, help us understand recent shifts in the net aggregate opinion of all market participants, and they help us monitor the present-day battle between bullish conviction and bearish conviction. And since tracking the net aggregate opinion is radically different from predicting or forecasting, the only way that we can properly use these setups is to head into next week and every week with that flexible, unbiased, and open mind. It may also be worth a visit to the new website to see the FAQs. We've got new and expanded FAQs covering traditional investing, low-cost passive investing, and the online/robo strategies that are currently in vogue. The material in this video has no regard to the specific investment objectives, financial situation, or particular needs of any viewer. This video is presented solely for informational purposes and is not to be construed as a solicitation or offer to buy or sell any security or any related financial instruments, nor should any of the content be taken as investment advice. Any opinions expressed in this video are subject to change without notice, and Shavaco Capital Management, LLC, or CCM, is not under any obligation to update or keep current the information contained herein. CCM and its respective officers and associates or clients may have an interest in the securities or derivatives of any entities referred to in this material. CCM accepts no liability whatsoever for any loss or damage of any kind arising out of the use of all or any part of this material. We recommend that you consult with a licensed and qualified professional before making any investment decision.